Andrew Pease. Andrew is Chief Investment Strategist for Asia Pacific at Russell Investments. Andrew, thank you very much indeed for joining us. Well, what do you make of it? Are they going to pull the rabbit out of the hat as usual in the last minute?
Well, that seems to be the pattern right now. We are locked in that sort of pattern of last-minute deals, but the big change over the last month has been the ECB's decision to inject those LTROs, those long-term refinancing opportunities, into the three-year bank funding. So what we're seeing now is a more stable outlook in Europe. Yes, there will be a last-minute deal, but it looks now more likely than it did, say, 3 or 4 months ago, that the muddle through is the most likely scenario for Europe through 2012.
Andrew, reading your notes, it seems to me that it's almost like Europe has to go through some sort of cathartic process before it can implement what you're saying are 3 legs that it needs to really get in place in order for there to be a survival here of the Eurozone. Walk me through that.
Well, we've seen one of them. The important one was what we were, because where we were a few months ago was we're really facing a liquidity crisis, and we were facing one of these self-spiralling crises of confidence, particularly reflected when Italian bond yields went above 7%. And the one thing we thought that could really stem that was unlimited liquidity provision by the European Central Bank. And to an extent we've had that, 500 billion euros of 3-year bank funding in late December, potentially another 500 billion coming up at the end of this month. That's a significant liquidity injection. So that's one leg that's really been ticked off. The second one was we really wanted to see some realistic restructuring, particularly in Greece. There has to be a realistic appraisal that Greece is insolvent and cannot manage the current debt burdens. We're heading in that direction. It's likely that we're going to see some sort of default in Greece, and certainly some sort of credit default, probably one that triggers CDS contracts. But the fact that we're moving towards that, and there now is a realisation that Greece is a special case and has to be regarded as insolvent, that's important. And then the final leg is the leg moving towards greater fiscal unity across Europe, and we're getting there. As with all things in Europe, the progress is painfully slow, but when you compare where we are now to where we were a year ago, there really has been some meaningful progress made, I think.
Andrew, I wanted just to look here at what else Europe needs, because it's not just about Greece, and of course we could also kick it along to Portugal, but if we look at Spain, France and Italy alone, I think they need something like 650 billion euros in funding. Now, do bond investors really have the stomach to be taking on that risk?
Well, probably not. We're not really seeing much of that now, and that's going to be one of the issues as we go through 2012. Who outside of the European Central Bank and potentially ESMs or EFSFs, who outside of these sort of official purchases is going to be left to buy those bonds, and particularly with Europe heading into what looks to be a reasonable recession this year, and some of those countries with the prospect of negative growth extending potentially into 2013. That's the big challenge. But what we do have now, which we didn't have 3 months ago, is we have a much more proactive European Central Bank, and that's very important. I don't think that should be underestimated in terms of being able to stop this from developing into a larger crisis and actually seeing the moves towards more sustainable footing. So yes, it's hard to be optimistic about Europe's economy, and certainly Europe's economy is going to be a drag on the rest of the world through 2012, but at the very least we can see that the sort of financial apocalypse that looked possible late last year, that's now looking less likely.
Andrew, well, of course, you mentioned the rest of the world. I want to talk about Asia. How does it affect things here? And if we look at equity pricing at the moment, how much is that actually factored in to what we've seen? Albeit we have seen this bit of a run-up take place since the start of the year.
Yeah, and January's been a fabulous month, and we've seen that extend into February as well. And really, equity markets globally were pricing in the risk of some tail events through late last year. And we know the story. The US has started 2012 on a firmer footing, and we've got less tail risk coming out of Europe now. So equity markets around the world are quite correctly pricing in that slightly less risky scenario. And Asia, of course, being a high beta region, is pricing that in more aggressively. And the valuations in Asia heading into the end of last year, whilst not as good as in early 2009 at the bottom of the financial crisis, on any sort of medium-term appraisal, Asia's equity market valuations were quite compellingly attractive.
Andrew, thanks so much for joining us, Andrew.